Hey everybody, welcome back to Investing with Wesley. In my previous episode, I talked to you about the importance of finding the intrinsic value of a company. That way you can determine if the price you're paying per share is fair, undervalued, overvalued. It gives you a better idea of just exactly what you're paying. Because remember, whenever we're buying an investment, we're treating it like we're also buying a money printer. And does it make sense for us to spend whatever amount of money we're about to spend for the estimated revenue that we're going to receive from this money printer? Like in my last video, I gave you the example of buying a money printer with the intent to hold it for 30 days. This money printer was going to give you $1 a day, so it wouldn't make sense for you to pay $100 for this money printer when you're only going to get $30 back at the end of the day. But it would make sense for you to pay $10 or even $15 because you know you're going to get double that by the end of this holding period. And that's the whole premise of finding the intrinsic value. In this episode, I want to go over the numbers and exactly how to do it so that you could have a better understanding in this example. With that being said, let's get into it. Okay, so in this example, we're going to be analyzing Google. And later on in the video, I'm going to give you an example of how important it is to get the growth value correct. But before we get into that, let's recap what the 6 steps are to calculating the intrinsic value of a company. Well, there's 6 steps. Step number 1, though, is to find the current free cash flow. Now, once you have the free cash flow number, you want to grow that number by 10 years. Now, once you have this, you take the 10th year's free cash flow and multiply that by the multiplier you were using. Now, once you get this, you have step number 3 completed, which is find the terminal value. Now, discounting the future cash flows is step number 4. Step number 5 is to add all those cash flows together, including the new discounted terminal value. Add all those things together, and that gives you the big number you're looking for, which is the intrinsic value of the company. And the 6th and final step is to create yourself a moat of safety. The first step is to find its current free cash flow. Now, Google's a large enough company where you could literally search what is Google's free cash flow, and it will give you the free cash flow for the previous year. Now, in step number 2, you want to grow that free cash flow rate by 10 years, or however long you plan on holding it. For this example, we're going to be using 10. Now, this is the part of intrinsic value that requires you to do a lot of research to figure out if the growth rate that you come up with is actually accurate or not. Now, some of the things you can look at are Google's previous 10 years and what that average growth rate is, the industry as a whole and what that growth rate is, as well as Google's future profit drivers. Are they going to get most of their revenue from ads? Are they going to get most of their revenue from purchasing other business? Or are they going to get most of their revenue from virtual reality and the new market that's developing? So let's say you did all that. Let's say you searched up what Google's free cash flow rate was and it led you to this website, Macro Trends, and you averaged the past 10 years worth of growth and you came up with a multiple. You came up with 25%. That's you saying that you think Google is going to grow as a company and grow their revenue 25% every year for at least the next 10 years. Now, if you remember from my last video, I told you that the multiple of 25% is an extremely optimistic multiple. And I also gave you the warning to be realistic. And if you actually look at certain things in the company and do the research, you could reasonably believe that they are going to grow 25%. So in the first example, we're going to do everything with the multiple of 25%, which leads us to step 3. Step 3 is growing the free cash flow by that multiple, in this case 25%. Now, making it easier on myself and getting rid of the decimals, you'll see that the numbers listed out in the 10-year growth of free cash flow is a starting point of 67 billion. Then it grows to 83, 104, 130, 163, 204, 255, 319, 399, 499, and then finally 620 billion. That is the 10-year growth timeline of the free cash flow. The next step is to find the terminal value. And this is the big check that someone would have to pay to you in order to buy that business from you. So how to calculate the terminal value is to take your final year's cash flow, in this case it's 623 billion, and multiply it by the same multiple you were using, in this case 25. Now, doing that, you get the terminal value of 15,575 billion. This is the check that someone would have to write if you owned 100% of Google and someone was trying to buy you completely out. But that terminal value is not the terminal value that matters. The next step is to discount all those future cash flows because you want some room for your investment to grow. Let's say you wanted your investment to give you 15% return year over year for the next 10 years. You would want to discount everything by that 15%. This gives you a new 10-year timeline for the discounted future free cash flow. These numbers give you 72, 79, 86, 93, 101, 110, 120, 130, 141, and then finally 153. And now you want to find the terminal value of the discounted free cash flow. In this example, the terminal value would be discounted all the way down to 3,825 billion, a significant decrease from the 15 trillion we started with. Now, in order to find the intrinsic value of the discounted future cash flows, you have to add all these discounted cash flows together with the discounted terminal value, and adding all those numbers together will give you the intrinsic value. Doing the math for you gives you an intrinsic value of 4,900 billion. But obviously we know we're not going to be right 100% of the time. So the final step is to build yourself a moat of safety. And just for the sake of this example, we're going to bet that we're going to be wrong at least 50% of the time and discount our intrinsic value an additional 50%, giving us that 50% moat. Doing all of this gives you the buy zone. What market cap does Google have to be in order for us to start buying its shares and be well within that buy zone? Well, assuming we calculated its intrinsic value properly and then gave it that 50% moat, our buy zone would be when the market cap of Google reaches 2.4 trillion or lower, which at least at the time of recording this video, Google's current market cap is 1.77 trillion. So we are well below our buy zone based on these calculations. Meaning if we did all of this correctly, then now would be a perfect time to buy this stock. But let me show you what could happen if that multiple that we talked about in step number 2 goes wrong. Let's say you just weren't accurate in your research, or maybe you weren't realistic, but let's say we were wrong about that 25% growth rate. And let's say that it's actually more of a 10% growth rate. Watch how the numbers could drastically change and make your entire decision to invest no longer worth it. So let's do it all over again, only this time with a 10% multiple. We still start off at 67 billion and then grow that 10% year over year for the next 10 years. That gives us a starting point of 67 billion, then it grows into 73, 81, 89, 98, 107, 118, 130, 143, 157, and finally 173 billion. Getting the fair terminal value of this would be multiplying your final cash flow by 10, since 10 is now our multiplier. This gives us the terminal value of $1,730 billion. Now we discount it, and we're going to discount it the same as we did the first example, because we still want our investment to grow 15% year over year. So we will discount it by that 15. Now in this discounted example, we'll get 63, 61, 58, 56, 53, 51, 49, 46, 44, ending at 42. Now the discounted terminal value would be 420 billion. Adding the discounted terminal value plus all those future cash flows that we also discount would give you an intrinsic value of 943 billion. Now, assuming we're still going to be wrong 50% of the time, we have to discount the 943 billion and basically cut it in half for it to reach our buy zone. Now, adding that moat of 50% to enter the buy zone for us means Google's market cap would have to drop all the way down to $473 billion just to hit our buy zone so we could start buying. Now, in the first example of a 25% growth rate, even with that 50% moat, we calculated its market cap to be in the buy zone of over $2 trillion. And now, with a multiple of 10 instead of 25, it's dropped all the way down to less than half of 1 trillion. So like I said, you could reasonably believe that Google would grow 25% just based on some of its numbers. But if you aren't realistic and maybe you overestimated or overvalued this company out of optimism, and it's really something more like 10% growth, then you could think you're in the best possible buy zone ever when it comes to this company. But in reality, you're still paying way overpriced if the real buy zone all along was at 471 billion as opposed to the 2 trillion that you thought it was at. This is why it is so important to look at your numbers specifically and be very conservative in whatever kind of growth rate you come up with. Because if you're too optimistic and not realistic, it could totally throw you off in calculating the real intrinsic value of a company and make you buy something that's actually way overpriced. Now, I'm not saying that Google is overpriced, and I'm not saying it's in the buy zone, because on both examples, the multiple that we chose, I just made up. I didn't do any research to determine whether 10% was right or 25% was right. And yes, although I did make up the multiples, I still showed you step by step how to go through the math and how to actually do it. So I'm hoping you take this knowledge, you go to Google, you do all the research yourself, you come up with a different multiple, and then do all the math to calculate its real intrinsic value. Who knows, maybe you'll stumble across your next winner. I hope you got value in this video. If you did, please remember to like and subscribe. I also have a dedicated Facebook and Instagram account where I post updates to the channel and what's going on and different ideas and different tips I have. So feel free to add me or follow me there. But either way, the choice is yours, and I'll see you in the next episode.